A market can move downward with total predictability for several days, only for the price to suddenly scatter. It leaves thousands of traders trapped as the momentum flips. This is the bearish three-line strike. 3 consecutive red candles step downward, creating lower highs and lower lows. Then a massive 4th green candle erupts. It opens at the bottom and surges up to swallow the previous 3 red candles entirely. An untrained eye sees this explosion of green as buyer dominance, assuming a wave of capital is forcing the price higher. But technical analysts classify this exact formation as a bearish signal. Despite the giant green candle, the market is positioned to continue its drop. Relying on the shape of a candlestick alone is risky. A pattern's meaning depends on its geographic location on the broader chart. Here is a line chart depicting a steep macroeconomic downtrend. When we zoom into the middle of this downward slope, we find the 3-line strike forming in its most common environment. In this environment, the giant green candle represents a temporary pullback, buyers stepping in against the dominant downward pressure. Notice the 5th candle. We wait until a new red candle drops 50% below the green strike's body. That drop provides the trigger to sell. To manage risk, the stop loss is placed at the highest tip of that green candle. Located in a downtrend, this pattern lures early buyers just before the primary downward pressure resumes. Now consider a different geography, a long uptrend hitting a resistance ceiling. The pattern is forming right at the peak. The initial 3 red candles show the rally is losing momentum. The massive green strike represents the final exhausted effort of buyers to pierce the resistance ceiling. The confirmation rule for this top-heady chart requires a subsequent candle to close completely below the bottom wick of the green candle. That break triggers the sell entry. The stop loss is again anchored at the highest peak of the green candle's upward push. At resistance, the strike confirms the momentum of the uptrend has stalled. Finally, look at a price crash resting on a major support line. The exact same pattern forms flush against the baseline. Because the pattern sits on a support floor, the green candle identifies a moment where buyers are successfully reclaiming control. We shift our perspective here. Traders wait for a new candle to break the high of the green strike to trigger a buy trade. For this long position, the stop loss goes directly underneath the absolute bottom of the green candle. The bearish pattern shifts into a bullish setup simply by changing its coordinates on the chart. We have observed the pattern in a downtrend, at a ceiling, and on a floor. While the entry rules and directions changed, one structural element remained constant. This split screen reveals the unifying mechanic. Regardless of the trend, the giant green strike candle provides a consistent structural boundary for the stop loss. This defined boundary helps manage the risk-to-reward ratio, keeping potential losses tight while leaving room for the trade to develop. Effective technical analysis isn't about memorizing isolated shapes. It requires a formula, the pattern itself, its location on the chart, and the final confirmation.